Hey everyone, and welcome to this explainer. Today, we're unpacking a topic that is absolutely the cornerstone of modern personal finance, mutual funds. We're going to take this massive and, yeah, sometimes kind of intimidating financial universe and break it down into clear, simple building blocks. By the end of this, you are going to have a rock-solid understanding of how these vehicles actually work under the hood. So let's get into it.
Okay, let's dive into this. Have you ever looked at the stock market and just thought to yourself, I know I need to be diversified. I know I shouldn't put all my eggs in one basket, but honestly, I don't have millions of rupees to buy 100 different stocks, and I definitely don't have the time to track them all day. It's an incredibly common problem. You want that perfectly diversified portfolio, but you don't have infinite time and you don't have infinite money. So how do we solve that? Well, the answer is a beautifully simple, elegant solution, the mutual fund. Think of it like a giant financial carpool. Because, if you want to travel a really long distance, buying your own car, paying for all the gas, and driving yourself the whole way is expensive and, frankly, exhausting. Instead, a mutual fund lets thousands of investors just pitch in for the gas. You all hop into a highly regulated vehicle, which is technically set up as a trust, and you hand the keys right over to a professional driver. That's your fund manager. They navigate the crazy markets for you, driving you straight towards your financial destination. Here's our quick roadmap for today. 1. Decoding mutual funds. 2. The mutual fund dictionary. 3. Advantages and limitations. 4. The menu of funds. And finally, 5. The industry boom.
All right, part 1, decoding mutual funds. Now, there's a really crucial distinction we need to make right off the bat. A lot of people think buying a mutual fund means you're buying some totally new, exotic financial product. But actually, scratch that. It's not a different product at all. It's just a different way of investing. When you put your money in, you're still ultimately buying equity shares, bonds, or money market instruments. The magic is in the professional way those assets are bought, the built-in diversification, and that super strict regulatory safety net. You're buying into a really smart process, not just a standalone product. Moving right along to part 2, the mutual fund dictionary. Let's get you fluent. When you pitch your money into that financial carpool we talked about, your investment translates into a specific number of units. But here's a pretty fun fact. Typically, every single unit of a mutual fund starts its life with a basic, foundational face value of exactly 10 rupees. That's your baseline unit capital. But of course, once that money hits the market, that 10 rupees doesn't stay 10 rupees for very long. So the real question is, how do we measure value as time goes on? That brings us to the two biggest acronyms you absolutely need to know, NAV and AUM. Think of NAV, or net asset value, as the price tag on your individual slice of the pie. It's the true daily calculated worth of just one single unit based on exactly how the underlying stocks or bonds performed that specific day. Now, AUM, or assets under management, that's the massive size of the whole pie. It's the total sum of all the money pitched in by everyone in the scheme. So NAV is your specific slice, and AUM is the whole bakery. Let's step into part 3, advantages and limitations. Let's start with the good stuff. Why does this actually matter for you? Well, first off, you get professional management. You've got full-time experts obsessing over the market, so you don't have to. Second, and this is huge, affordable diversification. You can get exposure to a perfectly balanced portfolio with literally as little as 500 rupees. It's amazing. Third, economies of scale give you way lower transaction costs. Throw in high daily liquidity so you can grab your money when you need it, totally transparent reporting, and awesome tax benefits like the ELSS, which lets you deduct up to 1.5 lakh rupees. And honestly, you're looking at a ridiculously powerful wealth building tool. But look, we have to keep it real. There are definitely limitations here. Mutual funds are what we call pass-through vehicles. That means they pass the market risk directly onto you, so there are absolutely zero guaranteed returns. Also, because you're in a massive carpool with thousands of other people, you kind of have to surrender the aux cord. You can't customize the portfolio. The fund manager decides exactly what to buy and sell. You also don't have direct control over the operating costs. And finally, because there are thousands of these schemes out there, investors very often hit a wall of major choice overload. Let's move to part 4 and see how this builds. We're looking at the menu of funds. To beat that choice overload, it helps to know how funds are structured. On one side, we have open-ended funds. Think of these like a revolving door. The fund operates perpetually, meaning you can buy in or cash out on literally any given business day at that day's NAV. Easy, right? On the flip side, we have close-ended funds. These have a fixed maturity date. You can only buy directly from the fund during its initial launch.
If you want to jump out early, you have to go find another investor to buy your units on the stock exchange, which often means you might have to sell them at a discount.
Next up, we categorize by the actual driving style. Actively managed funds are where you pay that professional driver a premium to aggressively race and try to completely beat the market benchmark. Passively managed funds, however, are way more chill. They just set the car on autopilot. They automatically mirror an existing index, like the Sensex. Because you don't have a highly paid manager making all these active, daily choices, these passive funds are way cheaper to run.
Now, SEBI, the market regulator, brilliantly organizes this whole universe so you know exactly what you're buying. For example, if you're chasing capital appreciation, you'll look at the equity menu. There, a large cap fund is legally forced to put at least 80% of its assets into the top 100 biggest companies. If you just want steady income, you hit the debt menu. A liquid fund, for instance, is only allowed to buy super safe securities that mature in 91 days or less. And if you want a bit of both, you look at hybrid schemes. It's incredibly structured, deeply regulated, and crystal clear.
And finally, Part 5, the industry boom. The sheer scale of this industry's recent growth is literally staggering. Just think about the total assets under management in India. Back in March 2015, the industry managed 11.89 lakh crore rupees. Fast forward just 10 years to March 2025, that number has completely exploded to 66.70 lakh crore rupees. Guys, that is an 18.82% compounded annual growth rate over the last decade. It's massive. So what's actually fueling this insane growth? Well, it's not just giant financial institutions, it's everyday people using systematic investment plans, or SIPs. The monthly SIP contribution grew from about 8,055 crores in early 2019 to a mind-blowing 26,400 crores by January 2025. The number of individual investor folios has crossed 23.45 crore. This is regular people waking up to the power of consistent, disciplined investing, just putting their money to work month after month after month. Which leaves us with one final vital question as we wrap up this explainer. The mutual fund structure has fundamentally democratized wealth creation. The vehicle is already built, it is strictly regulated, it's fully fueled by millions of everyday investors, and it is driving forward at an absolute breakneck pace. The only question you have to answer for your own financial future is this. Are you going to get in the passenger seat, or are you just going to stand on the sidewalk and watch it drive by? Thank you so much for joining me today. Keep learning, and I'll see you next time.